China's economy is struggling to get back on its feet after a year of COVID restrictions and crackdowns on everything from financial technology to private education and real estate. Industrial production and profits, property sales, and credit growth have all fallen short of expectation in April and May. The slowing momentum has already dented markets with the rise of commodities such as copper and iron falling, stock bearish and the yuan weakening against dollar. Consumer spending, which initially jumped after COVID-19 controls were eased at beginning of the year, has also fallen back on a gloomy economic outlook. Chinese exports contracted more than expected in May on weaker global demand for the country's goods as the world's second largest economy struggled to revive growth after a pandemic-induced slowdown last year. China's exports fell in May for the first time since February, adding to concerns that growth in the world's second largest economy could be faltering. Exports fell 7.5% year-on-year to $283 billion. Imports for May dropped 4.5% from a year ago to $270 billion. Profit at China's industrial firms slumped in the first 4 months of 2023. Official data showed companies continued to struggle with margin pressure and soft demand and faltering economic recovery. Profit fell 20.6% in January-April from a year earlier compared with the 21.4% decline the first 3 months, according to the data from the National Bureau of Statistics. In April alone, industrial firms posted a 18.2% drop in profit year-on-year. Chinese companies are struggling with both weak demand at home and softening demand in the country's major exports markets. Producer deflation deepened in April with the producer price index falling at the fastest rate since May 2020. Lenovo, the world's largest PC maker, witnessed a quarterly revenue and profit tumbled in January-March, and it had cut it to 9% of its workforce to reduce costs as a global demand for personal PCs continued to slump. Producers of steels and other industrial metal are also hurting. Price for steel reinforcing bars used in construction hit the lowest level in 3 years. Foreign firms saw their profits slide 16.2% in January-April from a year earlier, while private sector firms recorded a 22.5% plunge. Profits surged for 27 of 41 major industrial sectors during the period, with the ferrous metal, smelting, and rolling processing industry reporting the biggest slump at 99.4%. The grim profit readings came after a batch of April economic indicators spanning industrial output, retail sales, and property investment suggested that a recovery in the world's second largest economy is losing momentum. Beijing has a modest growth target of around 5% for this year, signs of a brisk recovery in the wake of country's abrupt end of COVID curbs last year. Nonetheless, some investment banks have recently lowered their 2023 China growth forecasts after the April data disappointment. Plans to compete for a larger share of the number 2 economy's $60 trillion financial market face challenge from a soaring business climate. Profit at Goldman Sachs, Morgan Stanley, and a clutch of other Western banks in China fell sharply last year as COVID-19 lockdowns and geopolitical tensions thwarted hopes that their operations in the country might finally start to be lucrative. Credit Suisse, Deutsche Bank, Goldman Sachs, and HSBC reported losses in their China-based units in 2022, and Morgan Stanley's profit fell. More than 3 years after China's grand financial opening, it's becoming clear to Wall Street giants that their dream of windfall profits from $16 trillion market are more elusive than ever. Goldman Sachs and Morgan Stanley are among the banks scaling back ambitious expansion plans and profit goals as a deteriorating geopolitical climate. The moves mark an about face for many of the Wall Street giants, which as recently as 18 months ago were sticking to plans to take on China's massive banks on their home turf and were more concerned about finding enough local talent to drive the expansion. For many firms, there is now a realization that they need a fundamental rethink on the world's second largest economy because the business climate has weakened significantly and best opportunities for making outsized profits in the economy are over. Experts believe that that this changing calculus makes the cost of doing business in China higher and reward much lower. These global banks are vulnerable to political actions that could inflict material financial harm to their franchises and to shareholders. The stakes are higher for international banks in market long viewed as the final frontier of big fees on everything from merger to stocks, sales and trading. JP Morgan, Citigroup, Bank of America, and Morgan Stanley had combined China's exposure of $48 billion in 2022, though that's down 16% from the previous year. Several banks have spent more than $4 billion in recent years acquiring controlling stakes in their securities and asset management joint ventures, banking on future growth. The backdrop of a more fractured geopolitical landscape means Wall Street firms have to strike an increasingly delicate balance. Publicly, everyone's saying the same thing. China is still a massive opportunity and they have no plan to pull out, especially since so much money has already been spent. On the asset management side, firms like BlackRock and Fidelity are pressing ahead to expand their fledgling onshore operations, though viral Vanguard Group plans to shutter its remaining businesses in China, and VanEck Associate Corporations has pulled back. But in recent weeks, the outlook has weakened, with the property market in particular showing signs of fragility. Sales fell to 63% of their 2019 levels in April, down from 95% in March. The property woes have spilled over to industrial production, which declined in April relative to the seasonally adjusted 2019 figures as demand for cement, glass, and other goods fell. Household consumptions, one of the main intended drivers of recovery, also lost ground. The fledgling momentum has driven up youth unemployment, which hit a record of 20.4%. Youth unemployment hit a record, while a key measure of investment also lagged estimates, casting a shadow over the outlook of world's second largest economy. Industrial production added 5.6% in last month from a year earlier, well below the forecast of a 10.6% rise. Retail sales expanded 18.4% on year, also missing forecast. These rates of growth partly reflect a contrast with the lockdowns last year in Shanghai, the country's biggest city. The economy had failed to fully recover following the removal of strict anti-COVID curbs last year, with a lingering property crisis and concerns over trade activity also clouding the outlook. An official reading on a property investment revealed a decline of 6.2% for the year to date, worse than analyst expectations of a 5.7% fall. Official data shows urban unemployment among the 16 to 24-year-olds in China hit a record 20.4% in April, about 4 times the broader unemployment rate. As youth unemployment in China rises to a record high, college graduates are caught in a perfect storm, with some forced to take on low-paying jobs or settle for jobs below their skills levels. Data from China's Bureau of Statistics shows that 6 million of the 26 million 16 to 24-year-olds in the urban labor force are currently unemployed. The scourge of unemployment is another issue that Chinese youths and policymakers have to grapple with. Moreover, China's factories also facing deflations. China's factory gate prices fell at the fastest pace in 7 years in May and quicker than forecast, as faltering demand pondered on a slowing manufacturing sector and a cost a cloud over the fragile economic recovery. Inflation in China stayed at low levels in May as economy struggled to recover even after its strict COVID lockdown measures lifted last year. Producer price index in May fell 4.6%, marking the steepest year-on-year drop in 7 years, when the producer prices saw a year-on-year drop of 7.2% in May 2016. Thank you so much for watching. Please like and subscribe my channel.